Hello, my name is Simon Conn. I'm the co-portfolio manager of the QVE Equities portfolio, which is an LIC listed on the Australian stock market, focused on the X20 sector of the market. The current economic backdrop is one of a challenge. It's a very difficult environment currently to grow your earnings. The feedback consistently from many of the companies we talk to is that there are many pressures on their profit and loss statement, and margins are very difficult to increase, and top line growth is pretty hard to come by in this current environment. There's a number of impacts, increased competition, increased regulation and the like. Despite that, with interest rates being so low, what we're seeing in the share market is the share market itself trading at very high levels. This is a factor of investors looking for income and coming into the market, bidding up the share prices. All those companies which are generating growth being bid to very excessive and extremely rich valuations, pushing the share market up. It's not really, we're not seeing huge levels of earnings growth in the current environment, making it very difficult for a disciplined value manager like ourselves in the current environment. The whole thesis around investing, bringing the QVE portfolio to market, was to give investors the opportunity to invest outside the top 20. The Australian share market is heavily concentrated in the top 20 stocks listed on the ASX. These companies are dominated by the banks and the resources sector, which make up about 2/3 of the top 20 sector of the market, which means those investors who invest purely in the top 20 companies they feel more comfortable with because they're familiar with the names of those companies, are very heavily focused or heavily exposed to the banking sector, which obviously comes with huge risk given the leverage in banks, or they're heavily exposed to the resources sector. And given the volatility of commodity prices, this makes the earnings of those companies quite volatile and also can make the share prices very volatile. Conversely, if you look beyond the top 20 sector of the market, there's a whole range of good quality companies available for investors to access, which gives them some diversity away from the banks and resources sector. So outside the top 20 sector of the market, you can get exposure to the gaming sector. There's a broad range of healthcare stocks. There's much more variety on offer. And there's some good quality companies outside the top 20 sector of the market. And this is a sector of the market that Investors Mutual has been investing in for over 20 years and knows very well. And it's really our skill set bringing that X20 skills to the LIC investor. So QVE Equities, listed in August 2014, has now been in operation just over 5 years. It's managed here in Sydney by Investors Mutual, an equity specialist who focus purely on Australian equities, in a long track record of consistently applying our mantra to the Australian share market, and built up a very strong track record which has been well awarded over many years. It's a portfolio, as I said at the outset, focused on the X20 sector of the market. It's run by a very experienced board, an independent chair in the name of Peter McKillop, oversee the investment strategy and the application of our investment process to the portfolio. And we're very focused on long-term capital growth and income. We're not high traders of the portfolio. We're really looking for long-term portfolio positions, good quality companies we think can grow their earnings and hence their share prices through time, and also generate a good level of income from their underlying businesses, which they can then pay out to the company, and we can distribute them to shareholders of the QVE portfolio. Our investment philosophy has been consistent since inception of Investors Mutual back in 1998. So we have a set mantra in the way we approach the market, and we look to apply that in investing in the market. So we look for companies that have got a strong competitive advantage. We look for companies that have got some sort of economic moat or ability to control and have some influence over their outcomes. So some pricing power and ability to influence the outcomes in their sectors. We look for those companies because we look for companies with competitive advantage or market leaders predominantly because they are the ones more likely to be able to have the scale to invest in research and development, to bring new products to market. They're the companies that have got the competitive wherewithal to ride through the economic cycles and be resilient in downturns, to emerge out of any economic downturn in stronger shape and to continue to invest in their business going forward. We invest in companies that have got a more recurring and a predictable earnings stream. So we look for businesses such as the packaging sector, such as the gaming sector around grind casino operations, where they have a consistent level of earnings. And the reason for doing that is to invest in those businesses because the underlying earnings are more resilient. Well, the share prices and the earnings of those businesses should be more resilient through economic cycles. It also means those businesses are more likely to generate good returns on capital because they're able to budget what the outcomes will be given their investment in their business, and more likely to be able to deliver good longer term returns for shareholders. We look also for businesses that are run by a cable management team, and the investment team based here in Sydney spend a lot of their time talking to the management teams that operates the businesses that we're investing in, understanding what's driving and motivating the management teams and where they're investing their capital, and understanding what the disciplines around the business, understanding the culture of the organisations that we invest in, so that we make better placed to make good returns for our shareholders over the longer term. We're also looking for companies that can grow through time. Obviously, we want companies that can continue to sustain growth through the cycle, and looking for those businesses to be able to generate growth over time, but all at a reasonable price. So we are a disciplined value manager, and we apply our approach through the cycle. But we're looking for companies that are trading below our assessment of their valuation, and we have a discipline around exiting or reducing our holding or selling out of those stocks once they reach or exceed our valuation targets. In terms of our current positioning, as I said at the outset, the economic environment that we find ourselves in is quite of a low growth nature. And in that environment, and we've been applying this approach for some time, we're looking for companies that we think have got initiatives or self-help initiatives that can help them drive their growth, the earnings growth of those companies going forward. Some of the initiatives we've been identified and looked for in companies are cost-out initiatives. And a good example of that is a company such as Tabcorp, which is investing significantly in the technology platform that sits behind their lotteries and wagering business, which is enabling them to take costs out of their business, but also more importantly to target their marketing through social media and the online channel to generate higher yields and to make the business more productive. We look for companies that are making acquisitions. And so a great example of that is Amcor's acquisition last year of the Bemis portfolio in North America, which consolidated their position in that market, and it's the synergies that they're now generating from that acquisition which are driving the earnings of Amcor's business. It's those companies that have a contracted or annuity style growth, and so Sonic Shopping Centres Australia is a great example of a stock that we've had in the portfolio for a number of years that's been able to generate consistent earnings growth from their underlying portfolio of neighbourhood shopping centres. So these are effectively neighbourhood essential shopping centres, so 50% of their rent and their turnover comes from supermarkets, so Coles, Woolworths and Aldi. The other 50% from non-discretionary or low, fairly stable, predictable tenants such as bakers, butchers, pharmacies, medical centres and the like. And that portfolio is going to generate good growth over many, many years, is very well managed, led by Anthony Mellows, and has been a good performer for the portfolio. We look for companies that are able to take market share in their sectors. So Orica and GWA are two good examples of companies that have invested heavily in their portfolio set and have brought new products to market. Specifically, GWA have had very good success over the last 3 years with their new Clean Flush range of vitreous China toilets. It's a cleaner and neater product. It's really resonated with the consumer, and it's seen them re-enter the Reece and take market share in the vitreous China sector of the market. And restructuring stories are another part, another area that we've been investing in. Crown Resorts is a fantastic example of a stock where the company has exited their offshore operations and focused back on their core main gaming operations here in Perth and in Melbourne, two very resilient grind-based casinos where the businesses generate very good cash flow. And obviously with the Barangaroo project under construction, soon to be completed. Once that's complete, we'll see that hotel and resort complex come into operation and start to augment their earnings streams. But again, a stock we like because of its resilient cash flows, conservative balance sheet, good management, and ability to pay at the current prices a 60-cent dividend, which equates to about a 5% yield. So what should an investor expect from a value manager? Well, we believe investors investing in a portfolio managed by a value manager should expect key tenets. One of the key things is reasonable capital growth through time. Importantly, also resilience in falling markets, and so a less volatile outcome for investors in that portfolio. But also a consistent level of income, and importantly, while share prices may move, I think it's the dividend streams that companies generate is one of the main consistent things that you can expect from a portfolio of stocks. And also the tax and added tax effectiveness. So obviously the franking credits that companies are able to pay out to their shareholders and we're able to distribute to our investors is also a key augmentation and additional extra return that investors should get from a portfolio. And these are the key tenets we think you should expect from a value manager, and this is what we look to deliver at Investors Mutual. With that, thank you very much for listening. If you have any more questions, please visit the QVE website or fill in the questionnaire below. Thank you.